Thank you. Thank you so much. Virtual National Tax Conference. I welcome the following dignitaries on the dais for this session. Shri P.K. Bansal, Chairman of the session. CA PVSS Prasad, Speaker of the session. Shri O.P. Shukla, Conference Coordinator. Shri Virendra Popat, Bhiwandi Tax Practitioner Association. I now invite CA Virendra Popat to introduce Chairman and Speaker of this session.
Thank you. Thank you very much, all of my 532 persons who attended and give the opportunity. Shri Praveen Kumar Bansal is one of the Vice Presidents of Income Tax Tribunal, retired from Mumbai in January 2018. He is the Company Secretary, Chartered Accountant and LLB. He is the rank holder in the CA Inter 1975, 39th rank in India in CA Inter. He is also first rank in CA final of North Range and the 30th All India 1978. Immediately after becoming a chartered accountant, he started his own practice as a CA firm, Vinod Praveen and Associate. While being the practice, he has a vast experience of different fields of the professional related to finance, accounting, administration, consulting, and taxation. After that practicing in CA for near about 20 years, he joined as a tribunal in 1997 as an account member. He served 20 years in the tribunal as a member and provided the vice president's ITAT in March 2017. During the ITAT, he had the opportunity to serve near about 23 stations across the India, either as a station member or two, which is as the single record. He is having the judicial experience residing the appeal relating the income tax. He is dispersed the highest number of appeals every year as a member and as a vice president of the income tax tribunal. He was the disposed of the appeals immediately. He is delivered the number of landmark decisions which of the affair in the Supreme Court, Hyderabad Supreme Court. On such cases, the case of Reliance Petroleum Production, which is the wide relied by the professionally. This case is the affair by the Honorable Supreme Court. In has finally his ability to grasp the man issue the matter of the hand and he quick the decision making the so command in the subject is a vast knowledge of his income tax. He is also the life member of Indian Institute of Law, Bombay Chartered Accountant Association. He is also remained as a secretary of Commercial Association JV Jain College, Taranpur, Secretary of All India Income Tax Appellate Tribunal members and Association of till the Supreme Court. Member of the Finance Law Committee of the Institute of Chartered Account of India for 4 years and concerned as a treasurer, founder member and part of various charitable social welfare organized in Noida. Welcome, sir. Welcome, P.K. Bansal, sir. Please, P.K. Bansal.
Thank you.
CA Shri PVSS Prasad, CA O.P. Shukla ji, CA Virendra Popat ji, CA Vikram Nankani ji, Senior Advocate, Srimati Prem Lata Bansal, Senior Advocate, Shri P.C. Joshi, Senior Advocate, Mr. Srinivas Rao, CA Deputy President, All India Federation of Tax Federation, Shri J.D. Nankani, Senior Advocate, CA Keval Ramani ji, CA Kamlesh Sabbu, CA O.P. Shukla Advocate, Shri Arvind Mishra Advocate, CA Bharat Sachdeva, CA Manoj Moryane Advocate, Haresh Shughani, GST Practitioner, Shri Atem Tek Chandani Advocate, Shri Arvind Shukla ji Advocate, Shri S.K. Yogeshwar, CA Rakesh Agarwal and other dignitaries, office bearers and members of the Tax Friends Association, Mumbai, office bearer and members of the Tax Practitioner Association, Thane, office bearer and members of the Tax Bar Association, Prayagraj, Mr. J.P. Prayagraj, office bearers and members of the Income Tax, members of the GST Bar Association Varanasi, office bearer and members of the JOS Professional Foundation of his peers and members of the Bhiwandi Tax Practitioner Association and other professionals, both gentlemen and gentlewomen. Jai Hind. I hope you and your families are safe and healthy during this difficult time. I congratulate the organizers of this National Tax Conference, being the first of its kind on taxation in India through digital mode, for taking the pain during this hard time of COVID-19. The impact of the COVID-19 has been profound. I also congratulate the organizers for arranging more than 60 virtual conferences on taxation to enlarge and enlighten the knowledge of the young professionals in such difficult time and make them aware of the new technology of having meeting through the web. The spread of the virus has strained local medical infrastructure, introduced travel restrictions, limited social contacts, and created unprecedented disruptions not only to domestic economy but to the global economy. A wide variety of industries are seeing disrupted supply chains, reduced customer demand, curtailed operation and output, decreased liquidity, and significant changes to how business is conducted, that is working from home and virtual meetings. The topic selected is the need of the day. The foundations for the current international tax system were laid early in the 20th century when transnational corporations were in their infancy and most international investment flow consisted of private and public loans. The aim was to ensure that they reflected the net business income which it might be expected to derive if it were an independent enterprise engaged in the same or similar activities under the same or similar conditions. This became known as the arm's length principle. By the second half of the century, transnational corporations become increasingly dominant in the world economy, managing operations in different countries. They also developed increasingly complex techniques for reducing their overall taxes, exploiting the loopholes in the loosely coordinated international tax system. International tax avoidance involves two main methods. First, transnational corporations can create intermediary entities in convenient countries, usually those countries where there is no tax or low income tax, known as the tax haven, to carry out the activities that is financial transaction, transportation, providing advice or other services, or to act as holding companies owning assets like intellectual property rights, bonds, shares. By attributing profits to them, the group overall taxes can be reduced, even though they usually exist only on paper, perhaps with a nameplate on an office building. Secondly, a translation nation corporation can adjust the prices of the transfer between the
I think there is some technical glitch. Please bear.
Bansal sir, your voice is cracking, some internet issues.
corporation group to shift profits from the locality. This is not that concerns to the audible. Hello.
Yes sir, now थोड़ा बीच में connection गया.
Just a minute. Is it okay?
Yes, very much.
To combat the use of the tax havens, in 1962, US enacted the measures to include in the profits of a US parent company the income of its affiliates formed in the low tax countries if they fall within the definition of a foreign corporation. Many other OECD countries later introduced similar rules. Subsequently, US introduced detailed regulations in 1968 elaborating how such prices should be determined. Where possible, the
बंसल साहब आवाज में प्रॉब्लम
pricing of the specific transaction. Studies showed that the comparable could be found for only a minority of cases, and applying this was time-consuming, burdensome, and created uncertainty. In 1988, the US Treasury, where comparable could not be found, proposed a new method for calculating an arm's length return, attributing to the affiliate a profit based on analyzing its function and applying an industry average rate. The comparable
There seems to be a net issue with
there seems to be some problem.
Bansal sir. There seems to be a network problem at your end.
Yes. At the Bansal place,
Hello?
there is some.
Sir, there seems to be an internet problem at your end. Problem with connection.
Network problem or what is there?
Network problem. Your voice is breaking.
Yes, Bansal sir, now you speak.
Unmute, please unmute. Bansal sir, please unmute.
So you have to unmute.
I am unmuting myself.
Yes.
Yeah, now please.
Yeah, now you are able to hear me?
Yes.
Yeah. Studies showed that comparable could be found for only a minority of cases, and applying this was time-consuming, burdensome, and created uncertainty. In 1988, the US Treasury, where comparable could not be found, proposed a new method for calculating an arm's length return, attributing to the affiliate a profit based on analyzing its function and applying an industry average rate. That is called the comparable profit method, or we call it CPM. This caused considerably conflict within the OECD, but was eventually adopted as the transitional net margin method, that is called TNMM, in the revised transfer pricing guidelines of 1995. In India also, transfer pricing was brought in the Income Tax Act for the first time by the Finance Act 2001 by introducing Section 92 as well as Rule 10D under the Income Tax Act, so that income earned in India must be charged to tax, and the transnational corporation may not divert their profit without tax to other countries. Double tax avoidance agreements has also been entered into with the various countries. From a transfer pricing perspective, during the COVID-19 crisis, we would expect companies to record results which could differ significantly from normal business conditions and could possibly incur operating losses. While as the tax authorities appreciate that the losses can be incurred in independent situations due to the unfavorable economic conditions or other legitimate business factors, it remains to be seen how these factors can be identified and quantified for transfer pricing purposes. Further, from benchmarking perspective, application of the TNMM may entail inherent challenges in terms of getting appropriate comparable companies, particularly for the financial year 2021, which is going to be ending on 31st March 31st March 2021. At the time of preparing the contemporaneous documentation, availability of the data may practically be limited to two financial years, that is the financial year 1819 and 1920, both of which are not impacted by any COVID-19 downturn. Since impact on profitability will be visible for taxpayers and comparables in financial year 2021 margins, taxpayers would have to appropriately take steps to mitigate potential risk. In these times of uncertainty, multinational groups are likely to encounter significant internal changes, including the restructuring of the supply chain, renegotiations in contractual arrangement, etc., and may be expected to attract heightened attention from tax authorities worldwide. It is imperative for multinationals also to mobilize efforts now to ensure effective contemporaneous documentation is in place of in place of substantiating the arm's length nature of transaction in light of the current economic condition. Recently, as you know, the Australian Tax Office has come out with the guidelines in the types of the analysis that it would expect to be performed to assess the impact of COVID-19 on a company, which, in my opinion, is a much welcome move by Australian Tax Office. The COVID-19 outbreak has led many countries to implement border controls as a temporary measure to curb infections, and many employers find their employees working from home in locations outside their jurisdictions where employers typically operate or are located. International travel restrictions affect board of directors and employees of multinational enterprises alike who find themselves marooned in various different locations around the world. This may trigger a local tax purchase for which the employers has not planned. This will in turn give rise to international tax complications, including the increased permanent establishment risk and in some circumstances a change in the residential status of the employees as well as the corporate tax residency. In early May, as you are aware of, Center Board of Direct Taxes has eased the tax residency rules for the financial year 1920 for non-residents stranded in India due to the COVID-19 pandemic, which is a welcome move. We are in extremely uncertain times, predicting new norms and managing how business are run as supply chain are disrupted, business moving rapidly into digital integration, and above all, keeping safe and healthy, we have seen unprecedented rise in e-commerce and digitization of the business, with employees working from home to virtual meeting to online ordering of everything. The various countries are coming out with the guidelines and ways to keep their tax base intact in light of the increased digitization. Section 165 was inserted under the Indian Income Tax Act in 2016, which levied equalization levy. The scope as well as the levy of this has been enlarged in the budget of 2020. Further, under the OECD G20 inclusive framework of BPs, over 135 countries are collaborating to put an end to tax avoidance strategies that exploit gaps and mismatches in the tax rules to avoid paying tax. 15 action plans are being implemented to tackle tax avoidance, improve the coherence of international tax rules, and ensure a more transparent tax environment. These action plans cover inter-area transfer pricing and multinational instruments rules for exchange of the information and multilateral instruments rules for exchange of information and coordination between the countries having appropriately framed. I would leave it to our dear speaker to take it up in further detail. I would conclude by saying that in such times, having active dialogue with tax authorities to encourage them to have some relaxation or consideration for taxpayers would be highly appreciated, as the financial effects of the COVID-19 will soon be established when financial accounts are drawn and tax returns are filed for for the financial year 2021, for the assessment year 2021. Lastly, every cloud has a silver lining, and the silver lining in this time of COVID is more family time for all. I would say enjoy this time till it lasts. With these words, I hand over to our esteemed speaker, Mr. P.V.S.S. Prasad.
Shall I go ahead?
Sir, I have to introduce yourself.
Okay,
sir.
okay.
So, yeah. Sorry for at that time. And now I'm doing this.
Yes.
Sorry for that time, sir.
Virendra bhai, please continue.
CA PVSS Prasad is a BCom, FCA, DISA, and LLB. He is a practicing chartered accountant and information system audits, and is a partner as a Prasad and Prasad chartered accountant from Hyderabad since 1986. He is the past chairman of the Hyderabad branch Institute of Chartered Account of India. He is a past president of the AP Tax Bar Association and the past chairman of International Physical Association Hyderabad of Subchapters. He is co-author of a book titled is International Taxation, a Basic Study, published by the Books Corporations, Calcutta. He is also appointed one of the branch reported of IFCA Congress in 2010. That was held in the Rome, Italy, and the subject is tax and the tax advice application of anti-advising provisions. He is also chairman of the All India Federation of the Tax Practice South Zone for the term of 2010-11. He was also the member of the Committee International Taxation and Institute of the Chartered Accountant of the India in 2016-17. He was invited as a speaker of IFA Asia and Africans conference held in Mauritius, May 2012, May 2014, May 2016. He was invited as a Pacific Region Tax Conference 2016 held in the South Korea in May 2016. He is a regular faculty of the Diploma courses of International Taxation of ICA. He is also a member of the Committee of the International Taxation of the Institute of Chartered Accountant of India in the year of 2018-19. He is a presently Vice Chairman of IFA India Branch 2018-20. Thank you. And over to PVSS Prasad, sir.
Thank you, Mr. Virendra Popat, for generous introduction, and I thank at the outset Mr. Vijay Keval Ramani for inviting me to speak at this very landmark virtual conference being done in a very grand scale. And in fact, I would also recognize the presence of the Mr. Haresh Chugani and Bansalji, Shri P.K. Bansalji, Honorable Chairman of this session, and other dignitaries who are on the virtual platform. And it's my pleasure to be with you this morning to share some of my thoughts on the present state of affairs with respect to international taxation and how things are moving. And we are in most unusual times, and the pandemic is really creating havoc across the world. And never ever we would have seen such situation in our lifetime. In fact, when I asked even elders of age 80, 85, they are mentioning that they have not seen such a situation. Probably this would have happened 100 years back when Spanish flu attacked the entire globe in 1918. Anyhow, every calamity has some opportunities thrown to the economies, and this time we will just see. Can you just move this slide? Yes, next. No, previous. Our previous. No, prior to that. You're going forward. Don't go forward. Go back. Go back to the beginning. Next. That's COVID-19 pandemic, as mentioned, has disrupted not only a particular country's economy, but the global economy as a whole. And every country is a victim now. And we don't know when we'll come out of this. And in fact, no. Come back. Go back. Please go back. Crossbar. No, don't move. Till I tell you, please don't move. Cross-border movement of goods, service, people, intangibles, and financial flows have been really jeopardized. And now we are now coming out with new rules of living. And please don't move till I tell. Please, please. I don't know who is operating. Please don't move. I will just request, then you please move. Physical distancing has become the new normal, and we have to wear masks and go around. We are not in a position to meet our friends so freely as what we used to do in the past. In the same way, we're not having the seminars or conferences in the way we were having in the past. And the new virtual webinars are happening. And this is a classic example of such an event with an excellent participation of more than 530 people, I'm told. And physical distancing now has become the new normal. And the entire mindset has changed now. We are trying to do everything online. We are trying to become more techno-savvy, and we want to complete transactions right from payment of the small utility bill like your electricity or whatever may be the municipal taxes and all that, to the largest payment. You are going online and trying to do that. Next slide, please. And this physical distancing in our life has brought in so many changes in the behavior of the consumer or the citizens of the country. Most of the service sector companies are asking their employees to work from home. We used to always think that work from home is a feature that is available only in the software companies. And now it has become a very common thing among all service sector companies especially. And even among the brick and mortar system also, they're trying to they're trying to ask some employees to work alternate days and not regularly, and so many measures to contain this COVID pandemic spread and all that. And financial transactions, all of us know, we know how to operate Paytm now, how to make payments through Paytm, how to make UPI payments, and all this will have become quite familiar now. And in fact, even a housewife is well equipped to order groceries online, and fruits, groceries, vegetables, everything online now. And even meetings, as I mentioned, we have now the Zio Meet, the Zoom platform, what we're using in this conference, and also, the Google Meet and even Microsoft Teams and all that. And even over-the-top platforms have become so common today, where the most popular thing is the Netflix, where you have variety of movies in whatever language you want, and you will be watching them on the streaming of such movies at your most comfortable position in the houses. So all this has got a negative side because the economy is taking a big beating, and we'll all have to revive the economies. In fact, if you all remember, much before the pandemic, the economists were already struggling. And in fact, even our economy was really limping that time. And on the top of it, this pandemic has created havoc across the world. Next slide, please. And in fact, this is a picture imported from OECD website, which is giving the pandemics. The red is the pandemic, and the dark brown is the double hit. If at all the pandemic revives again, let us pray God that it should not happen. And in fact, they have given their projections. It's all negative projections if you have observed. And the double hit comes from down again. That is, if at all there is a revival or a relapse of the pandemic. And let us pray God that it should not happen. And go to the next slide. And this pandemic has led to lockdowns, affecting governments incurring huge expenditure for containment zones, for taking various healthcare measures, and ensuring that the citizens of the country are safe and healthy. Every government, central government and state governments have been doing their best in this particular unusual and unprecedented atmosphere and the environment. And Organization for Economic Cooperation and Development, all of you would call it as OECD, chiefly call it as the OECD, is a organization which has a focused body on taxation and which brings out the taxation principles which are recited by our honorable chairman during his inaugural address as to what are how the transfer pricing guidelines and how guidance is being brought by OECD for the purpose of various countries' consumption and all that. And OECD is really giving some sort of guidance as to what relief measures each government have to take, which even our government has taken some substantial measures. And in fact, OECD is looking at consumption tax and the environment tax as some of the avenues on which the governments might depend in the future post-COVID-19 to mop up revenues. And in fact, in this unusual time and trying times, there is always a silver lining, or I mean, some sort of positive dimension is, as we have mentioned, every transaction is happening digital. Now the digital organizations, digital companies are doing phenomenal business and they're going to record super profits. Already we have a lot of work being done by OECD as to how these digital transactions have to be taxed. That is what is, in fact, the challenges of the digitalization of economy is already a major issue before OECD and the inclusive framework of 137 countries, which are trying to arrive at a consensus approach to evolve a new principle of taxation to tax the digital transactions. At this point of time, the COVID and the post-COVID context would increase the importance of digital transactions in a big way and making it all the more important to arrive at an early solution as to what taxing principle should be adopted by everyone. Can we go to the next slide? And these are just a bird's eye view, a glance of some of the estimates made by one of the organizations called South Center in Switzerland, which has given some sort of estimates as to what each country is going to mop up on this digital tax unilateral measures which some of these countries have taken. In fact, pending consensus approach which is yet to be finalized, many countries, including India, have already initiated some unilateral measures to capture digital transactions, which our honorable chairman has already touched upon, which has been introduced in the form of equalization levy in 2016 and which got extended to a new format in 2020 Finance Act, which we'll discuss a little later. Can we go to the next slide? Next slide. Now, let us quickly get into, see, the COVID and post-COVID context also has overemphasized the importance of digital taxation, how these digital transactions are going to happen, how we have to capture and how we have to conduct the taxation system from each country where the users or the customers for these digital transactions are placed. And this is a billion-dollar question. We don't have ready answers today. In fact, OECD has been seized of this matter and set itself with a deadline of December 2020, which looks not possible in the advent of pandemic is number one, because of the COVID-19 is number one. Number two, US being, the largest economy, and US has got its own reservations, and thereby it has put some sort of pause in their participation in this, which we'll see in the later slides. And why you require a new taxation principle at all to tax the digital transactions? Why the existing rules would not help us tax this transaction is a question which we need to understand first. And in fact, as you all know, as mentioned by Honorable Chairman, our tax rules were designed, the existing tax rules or the pre-MLI or pre-BEPS existing rules have been designed 100 years back, around 1920s, by the League of Nations. They have initiated the process, and thereby you have come up with two principles as the source principle and residence principle. A person in resident, a person say in US, a business person, a business entity comes and does business in India, start opening a branch in India, then we'll have to tax such branch in respect of the activity carried on in India. That is called the physical presence on a permanent basis, which is otherwise known as permanent establishment. Whenever a non-resident goes out of his country to another country to do business and establishes himself in a more permanent manner than a temporary manner, and then projects himself in that country through his establishment, that establishment is known as permanent establishment, which concept has been explained in great detail by the Honorable ITAT in its landmark Honorable Andhra Pradesh High Court in its landmark judgment Visakhapatnam Port Trust. Justice Jagannath Rao has explained this PA concept in an excellent manner, and then this particular celebrated judgment is widely quoted across the world in every discussion of the international taxation among the academicians and the and the tax practitioners, and also before the industry captains. So whatever rule we have in the past is all on the basis of the physical presence of a non-resident entity in a source country. It's a very simple concept we need to understand. A non-resident country would be taxed in a source country. A non-resident from a resident country would be taxed in a source country only when he has permanent physical presence there, which is otherwise known as a permanent establishment. Then only he would be taxed, he or she or it or the entity would be taxed in that source country. So the entire taxing rules in respect of non-resident operating in a source country outside his country are dependent on physical presence of such non-resident entity in the source country. Now the technology has grown by leaps and bounds, and now the new business models have totally displaced the old rules as ineffective, because the large corporations, the digital corporations today, they don't require to operate in the old brick and mortar model. They would operate in a virtual model, as how we are conducting our conference today. Through digital means, they can operate and reach out to their customers, their users across the world. Google is a classic example. Facebook, you have Apple, you have all these techno giants from US. 9 out of 11 techno giants are based out in California, in the Silicon Valley of USA. And they have spread across the world their business activities in such a manner, and which you just cannot imagine. And all this business activity is virtually happening through digital means and not meeting the requirement of the physical criteria enunciated under the PE rules of the present taxation principles of international tax law. Thereby, all these corporations are not triggering permanent establishment to make any sort of payments in the source countries where they're really generating substantial revenues. So that is the main reason. And in fact, European Union has come out with a very detailed report on the digital taxation, which is an excellent thing. You can visit European Parliament's website and you can download their report, which is very, very informative about the digital taxation. And mind-boggling revenues are generated by these digital corporations through their digital means across the world without any physical presence. Today, if you have Google India is set up for a different purpose, and Google India is definitely paying taxes in respect of its income in India. That's a different proposition. But what mainstream of income they have through their customers spread across every country, including India, that doesn't require presence. That is for today we have the discussion how the digital transactions have to be brought to tax. The main limitation or the main problem we have in the existing rules is the physical presence requirement to trigger the permanent establishment of a non-resident entity in the source country, without which you are not able to tax the transactions. So, but the digital corporations do not require any physical presence to carry out their operations. For this purpose, for this sole and main purpose, we need to come out with a new taxing rule. That is the effort now going on among the inclusive framework countries, and thereby now we will have to decide which is the source country and which is the resident country, not on the basis of the old principle, but on the basis of the new principles of what are going to be brought in. Next slide, please. And in fact, pending this, because this action plans, as again referred to by the Honorable Chairman, have been, the reports have been, the whole BEPS project have started in 2013, and then the BEPS final reports have been submitted on October 5th, 2015. The first action plan is the challenges of digitalization of economy, or the digital economy. And in fact, that was kept open and not finalized that time. They have given some pointers and they have given some leads for the discussion, and it could not be finalized because it is very difficult to come to a conclusion at that point of time. Even now, it is difficult to come to a conclusion. Anyhow, that is the reason many countries now did not wait for the consensus solution to come up. Pending that, many, including India, have come up with unilateral measures to tax this digital transactions, which has created a lot of hue and cry, especially from US, and US is retaliating all these digital tax, unilateral digital tax measures through trade sanctions and all that. And then let's go to the next slide. And OECD's journey continued, though MLI has become a reality, incorporating the other action plans into a reality. And as far as India is concerned, it has become a reality from 1st April 2020, incorporating the other action plans and other principles, whereas digital taxation is still kept open for want of consensus and arriving at a foolproof solution. And in fact, in its journey to get into a consensus on the pending work, OECD's interim report has given some pointers as how we have to go about in March 2018, and how digital transactions are happening, how digital platforms operate and all that. And again, they have come up with some more refined information through their policy note in 2019 January. And again, as recently as January, in October, they have come out with the Secretariat proposal, which has given Pillar 1 and Pillar 2. Pillar 1 deals with the digital taxation specifically, and Pillar 2 deals with anti-avoidance measures and trying to tax the multinational corporations with respect to minimum rate of taxation, which is not subject matter of this particular presentation. And the unified approach deals with the digital taxation, Pillar 1, and it has given a proposal how to go about taxing these digital transactions in the source countries. Source countries are otherwise known as market jurisdictions, for our clarity and understanding in the entire presentation here now. Next slide. And OECD's program of program of work has developed 3 approaches to deal with digital taxation. The 3 proposals are user participation, because as you know, today Facebook has got innumerable users across the world, including India. India is one of the, high user-oriented country because of the high population here. And you have the other concept is the marketing intangibles, and the third concept is significant economic presence. For us to understand, the claim from each tax jurisdiction is today, if we have 130 crore population in India, at least 90 to 80 crore population is using Facebook or Google and Apple and all these digital transaction. All these digitally facilitated programs through these companies are being used by these users, because there is no cost attached to the user of these particular programs, softwares, or applications. That way, they have a huge user base, which user base is utilized through exploiting revenues from advertisements given to the corporates, because you have a huge user base of say 70, 80, 90 crore in India, and all multinationals or large business houses would like to use the digital space of Google or Facebook to advertise themselves. So this is the biggest revenue they have. Here the revenue model is totally different. Can you call these users as customers? We do not know, because no customer, no user is paying even 1 rupee to Google or to Facebook. But that is the real value creation for these companies, which database what they have of the users is the main attraction for various large corporations, companies to approach these giants to give the advertisements of their companies in their digital spaces. So user participation is recognized as a high value creating proposition for the digital companies. Thereby, countries in European Union have brought this concept and told user participation is good enough to claim a taxing right in that particular country if sizable users are there in that country, and through whom you are having sizable revenues. And then comes the marketing intangible concept. This marketing intangible concept dates back to the GlaxoSmithKline's popular drug, which sold in big volumes in US, and US IRS came out with a concept stating that your particular drug, if I am not wrong, it is the Genitac or something, and it has sold in huge volumes in US, which created super profits for the UK company. And the US IRS came out with a concept of marketing intangibles way back 15 years back. And they said, because this brand is well established and well publicized in this country, which gave you super sales and super profit, then an additional profit must be attributed to this country, because a marketing intangible is created for that particular drug in that market. So thereby US today also supports only marketing intangible concept to tax the digital transaction and not the other concepts. Significant economic presence is a concept canvassed by India in a big way, stating that this is one concept which will cover any type and every type of the transactions in the digital mode, and also the non-digital mode also is part of the significant economic presence. Because today it is very difficult to ring fence and say this is the digital economy and this is the non-digital economy. It is impossible to ring fence the digital transactions. That has been acknowledged by all the countries, and in fact even OECD has acknowledged that, because even the brick and mortar companies now are digitalizing all their transactions. Ford India, Ford the US has digitized most of their transactions. Like that, other companies, pharma companies, are digitizing their transactions. So it is very difficult to keep a strict line of demarcation as to what is digital companies and what is non-digital companies. Okay, these three proposals have been thrown for discussion by the pillar one. Next slide. And now the marketing intangible and the user participation. You broadly remember marketing intangibles is canvassed by US and user participation is canvassed by the European Union. And both of them are of the view that portion of the non-routine profits of the multinational, a Google-like company, if it is making a super profit beyond the routine profit, there's a non-routine profit in a particular jurisdiction, let us say like India, then India can claim a portion of that profit, which is commensurate with their presence in that particular country, is what is being worked out as a formula. We'll see how it is being worked out. And then significant economic presence, as I mentioned, India canvasses this rule, and in fact, portion of all profits, be it routine or non-routine. So significant economic presence says, no, you can't demarcate what is routine, what is non-routine. What is routine might become what is non-routine today might become routine tomorrow. So that is the reason there is no demarcation as far as SCA principle is concerned. Next slide, please. And they have come out. I'm not discussing this formula in a detailed manner for want of time, but I'm just giving the flavor of what they have proposed, which is not yet finalized. It is still at the consultation stage. US has not given its consent. All that I'm going to explain now. Amount A, amount B, and amount C. As mentioned by the Honorable Chairman, arm's length principle is the guiding principle when you have transaction between group entities in two jurisdictions. Why? What is the arm's length principle? Arm's length principle is nothing but when you are dealing with your own subsidiary outside India, let us say in Singapore, because Singapore has got only 17% tax rate, whereas we have got 33%, of course, 21%. I'm not discussing about that. 33% what we have all through these 33%. Suppose there is always a motivation for you to shift your profits to your subsidiary in Singapore, where the tax rate is only 17%, by way of selling your goods to your Singapore entity at a lesser price, or trying to buy raw materials from Singapore at a higher price. That way you would successfully shift your profits from India to Singapore. That is where the transactions have to be benchmarked at arm's length price by the tax authorities, and you will have to demonstrate that what I have transacted with my associated enterprise, with my subsidiary outside India, are comparable to any transaction that I would have done with an unrelated party in such circumstances. This is nothing but called the arm's length principle, which is the simple mechanism, simple and also the most complex, whatever you may say. So the arm's length principle guides the transactions between group entities among tax jurisdictions. Still, arm's length principle is still there, well intact, even under the digital taxation rules. But what they have arrived broadly is, over and above the arm's length principle, you have to use a formulary approach. That means you have to use a particular formula with respect to each source jurisdiction, that is called the market jurisdiction, where these digital transactions are happening, to arrive at what profits, what portion of profits would get taxed in such jurisdiction. That particular formula is going beyond the arm's length principle. As far as amount A, suggested by OECD in the unified approach, talks about deemed residual profit. Residual profit means non-routine profit of the multinationals. The consolidated profits must be taken, and you must arrive at a formula given by this approach after deciding what is amount B and what is amount C. Amount B is a fixed remuneration for baseline marketing and distribution functions. They have come out with a fixed remuneration, like your presumptive taxation, as how you give 8% profit for a retail trader in 44 AD. They would like to come out with a particular fixed remuneration for baseline marketing and distribution functions of a non-resident entity in the source jurisdiction. And then amount C is, if at all this particular entity is working beyond its normal baseline marketing and distribution function and trying to promote the non-resident's product in a big way, that may create a marketing intangible. And such extra efforts also should be benchmarked under the arm's length principle, and extra remuneration must be attributed to the source country where such activities are carried out. That is all amount B and C. Once amount B and C are finalized, you are still left with the residual profit, which is the non-routine profit. In that, a particular formula is being proposed to work out what is the proportionate share for each market jurisdiction. Google is just not operating only in India, across various countries in the globe. Then how do you apportion? A particular formula is given. Next slide. So that is how this is being called a three-tier profit allocation mechanism. Amount B and C depend on arm's length principle, which is already there in our understanding, and amount A is being derived at on the basis of a formula. That is the reason it's called a formulaic approach. And this summary, they have the last statement is 31st January. They have come out with a final statement stating that digital corporations must be separated and consumer-facing entities must be separated. And they are coming out with a concept called consumer-facing entities. Such entities alone will have to be brought under the digital taxation new principle. And in fact, for some business models, market jurisdiction is where the user is located. That is what we have discussed in the Europe, how European Union has brought out the concept of user participation, like your Facebook users, Google users, and all that, intended to restabilize the international tax system, assisted enhanced dispute prevention and resolution process. And these three, amount A, B, C, there might be some overlap which needs to be avoided. Otherwise, it would result in double taxation. Next slide, please. See, US has been not so well absorbed in this entire project for the simple reason US would be directly impacted because all the giant digital giants are from US, and the entire tax base which is getting mostly taxed in US, now they will have to distribute those taxes across the world, which is not to the liking of US. And US sees, in nutshell, US is supporting the existing international tax rules. And they strongly believe that the existing tax rules alone would answer issues of digital taxation also, which is not being agreed by as many as 137 countries in the inclusive framework. And US has come out with a very typical concept which is never expected. They told on 3rd December 2019, the entire digital taxation proposal and the unified approach, what you are coming out under Pillar 1, can be treated as a safe harbor regime. What is a safe harbor? Today we have safe harbor rules even for the transfer pricing in India, which no one is taking to that because the safe harbor rates proposed there are very high. Be that as it may, safe harbor is an option. If a taxpayer would like to get covered, he will go there. Otherwise, it's not a mandatory thing. So whatever digital tax proposition that has come out in the form of Pillar 1, US proposed that let it be treated as a safe harbor, which is strongly opposed by the entire inclusive framework of 136 countries. They said safe harbor has never been an idea which is discussed across this project for so many years, and we cannot accept that. That is what the OECD Secretary has replied to the Treasury Secretary of the US. And recently in June 2020, because of the severe pandemic, which is also impacting US in a big way, they have proposed that they are giving a pause. Pause is a very, it's a new coinage now for any sort of stopping the proceedings for a while. They said we would like to give a pause for this particular project because of this pandemic situation. That is what they have mentioned. We also know US is going through the presidential election now, which is coming up in November 2020. So I think the Philip Baker, one of the leading counsels in UK, who is Queen's Counsel, the other day in one of the webinars he mentioned, US has put a similar pause even in 2000 when some international tax proposals were going on that time because of the presidential election. The same thing is happening now also. We can expect the US to come back to the discussion table only after January or February 2021. Next slide, please. So now the key features that are under discussion among all the countries is scope. What is a consumer-facing business? A consumer-facing business will keep out B2B, that is business to business. Consumer-facing means business to customer. You are keeping out business to business. But whereas India-like countries are telling, why are you keeping out business to business out? Significant economic presence would cover everything. We should not keep out business to business. So there are some differences among various countries which are discussing now. And what is the new nexus? And they have proposed 750 million euro as a threshold to apply the new digital taxation rule. That means any corporation having revenue less than 750 million euro, that means roughly 5,500 Indian rupees. 5,500 crore Indian rupees. So if at all a particular corporation is having 5,000 crore revenue, then you are not applying the digital tax principle. India is opposed to that. It says the threshold is very high. You should not have a threshold. In the other place, you must have a lower threshold and not 750 million euro. And new profit allocation rules beyond the arm's length. For the first time, we are going beyond the arm's length principle and trying to give a formula for arriving at the taxation right of the source country, that is the market jurisdiction. So this is called the three-tier mechanism. Next slide, please. And India has come up with the equalization levy. Equalization levy is one of the proposals indirectly suggested by Action Plan 1 in 2015 final report. But they have given all the safeguards to be taken. They have said equalization levy must be levied in a manner respecting or complying with the international treaty obligations. That is very important. See, whatever levy you make, that should come within the four corners of the treaty obligation. That is one of the conditions, but we have not followed that. And the levy has been brought in, neither it is income tax, nor it is a transaction tax, nor it's an indirect, it is only a transaction tax. It is not an indirect tax, it is not a direct tax. And it is very clear, it's clearly explained that no credit can be given for this tax paid by the non-resident here in their resident country. So this is a double whammy. That means the entire profit what they earn is again subjected to tax in the resident country. Thereby, you are subjecting the income earned in the source country twice, which is not having any relief, which is against the basic principle of double taxation avoidance agreements and the treaty law. And originally, 2016, India introduced only advertisement income earned by non-resident from the residents of India should be brought under the purview of equalization levy at the rate of 6%. And they said if you do not, this 6% must be paid, must be deducted and then paid to the non-resident. A Google-like company, will they allow such deduction? I am a small business person in India availing Google services. If I have to pay $10,000, I am at a weaker side of the bargaining. And I would be said, you pay $10,000 net, whatever you do, I do not know. So ultimately that 6% cost is falling on me. It is adding to my cost. I, being a smaller businessman, has to take, being a resident of this country, my cost is going up. It is not genuinely being recovered from the non-resident. That is what has happened all these days from 2016 to 2020. And as a real shocking surprise, 2020 Finance Act has brought in an extended levy in the form of equalization levy applicable to the e-commerce operators at the rate of 2%. And in fact, a non-resident has to comply with equalization levy proposed in 2016 is an obligation cast on the resident payer making payments to non-resident company who is providing the advertisement space digitally. Whereas here, the non-resident e-commerce operator must comply with this rule of equalization levy, which needs to be paid at 2%, for which there is no appeal available. Appeal is available only for penalty order and not the main order. And it is very surprising that this has come without any discussion. This was not proposed in the Finance Bill 2020. It has come as a very surprising shock in 2020 because the digital taxation discussions and the US intervention and all this is delaying the whole process. And in the Finance Act, our government took a view to extend this levy to the e-commerce operator, which is creating a lot of uncertainty. So many issues have come up in equalization levy, which are still to be answered and clarified by the government. For want of time, I may not be able to go deep into that now, but that is the digital tax as of now, proposed and being levied. It has become effective from 1st April 2020 in India. The new nexus rule, significant economic presence also is proposed, but it is kept on hold till 2022 in the Finance Act. And introduction of, again, another withholding tax on e-commerce transaction, that is 194O. And for your kind information, 194O, which is proposed in the Finance Bill and continued in the Finance Act, will overlap with equalization levy 2. There are instances where these two would overlap and it creates another dimension of double taxation. And also, the Central Board of Direct Taxes has come up with the new attribution rules for permanent establishment in a draft report in April 2019, which also has some relevance for our discussion today. And in fact, that is still at the draft stage for the simple reason that this inclusive framework, OECD inclusive framework approach to digital taxation must result in a consensus solution. Next slide, please. And then we'll quickly come to the second dimension of today's presentation, and what is the most happening thing today, and what is a reality today. As how equalization levy has become a reality, today multilateral instrument is a reality. It's a new dimension to the existing tax treaty network. Next slide. That means the double taxation avoidance agreements, as many as 93 double taxation avoidance agreements, India has notified them as covered tax agreements, and all those CTAs are undergoing change because of this multilateral instrument. First of all, let me explain what are the action plans in nutshell in 1 minute. As you all know, all of you would have heard the BEPS action plans number of times from last 5, 6, 7 years. The BEPS action plans are nothing but anti-avoidance measures in the international tax context. They have identified where tax leakages are happening and how to arrest these tax leakages. And first of all, the top and the foremost thing which every country has agreed to arrest is the treaty abuse or treaty shopping. What is treaty shopping? We all know what is treaty shopping. India-Mauritius tax treaty, we all have seen the India-Mauritius tax treaty was used and utilized by third country residents by interposing a company in Mauritius and claiming the benefits of India-Mauritius tax treaty. Suppose a US entity or a European entity will float a subsidiary in Mauritius, and Mauritius in turn will invest into India, and India-Mauritius tax treaty would apply because there is no anti-abuse rule like limitation of benefits rule, insisting that not only the company must be a resident of Mauritius, but also the entire shareholders of the company must be residents of Mauritius. That rule was never there in the India-Mauritius treaty, like a rule what we had in India-US tax treaty. So that limitation of benefits rule was not there, because of which all third country residents have exploited Mauritius route to reach India. But of course, India has categorically agreed for such negotiation way back when Mauritius treaty was signed, and then that has come up as a big blow because at a later point of time, capital gains tax was abolished in Mauritius also, and thereby the capital gains tax which is sacrificed by India, not levied by India, was also not levied by Mauritius. Suppose these investments coming through Mauritius, if they want to exit the investment with all super profits, that gain was not getting taxed either in India or in Mauritius. That's a classic example of double non-taxation. So that is called the treaty shopping, and that needs to be arrested, and that is the most basic target of the BEPS action plan, which everyone has agreed as a minimum standard. That means minimum standard means every country, they will not have any option. They will agree to this because no one wants to lose their revenue. That is, prevention of treaty abuse is a minimum standard. In the same way, effective dispute resolution is also a minimum standard. Even the taxpayers' rights must be protected, and grievances must be redressed on time. So both these action plans, action plan 14 and 6 are the minimum standard, and the other minimum standards we have here. Action plan 1 talks about the digital taxation, and action plan 15 says all these amendments which we are trying to bring to various tax treaties must be brought in a very swift and effective manner. How you can bring it? If at all India-Mauritius tax treaty has to be changed, it took 10 long years to change the tax treaty, you know. It happened in 2016. The hue and cry started from the revenue authorities 10 years prior to that, say in 2005-4, they started, we are losing a lot of revenue, neither capital gains is brought to tax here when the Mauritius companies are exiting their investment in India, neither they are taxed here nor in Mauritius. So which plea got addressed through anti-abuse rules in the treaty in 2016. That means it took 10 long years to renegotiate a treaty. And the international group of experts have suggested that if you have to modify as many as 3,000 tax treaties, it would take another 30 to 40 years, by which time the proposals you're trying to make would become redundant. By that time, the technology would have taken many more jumps. That is the reason they have proposed a multilateral instrument must be brought in, which will be signed by all the inclusive framework countries so that their respective treaties get modified. Next slide. So this is the first of its kind and first of its scale operation, and developing a multilateral instrument modifying bilateral tax treaties concluded that multilateral instrument providing an innovative approach to the countries to swiftly modify their bilateral tax treaties to implement measures developed in the course of the BEPS project. And this is what is suggested by the group of experts, which has become a reality today. Next slide. And the journey of MLI, India is one of the front runners in the G20 because India is part of G20 and not a member of OECD, it's only an observer, but one of the prominent members and the most popular members and the most vocal members of the G20 group. And many of India's views have been considered and have been implemented. And the journey started like this. October 2015 is the release of BEPS reports, as I mentioned. So 2016 MLI draft, MLI instrument has been brought in for discussion. And June 2017, 7th June 2017, the MLI was signed by as many as 67 countries, including India, when the then finance minister, Mr. Arun Jaitley, late Mr. Arun Jaitley, went and signed in Paris. And 25th June 2019, MLI was ratified by India. And on 9th June, MLI was notified by the Ministry of Finance also. And it has come into force from 1st October 2019, and it has become effective from 1st April 2020. It is a reality now. We need to know how MLI operates. Next. And this is how the MLI structure has come up. I'm just giving a broad outlook of what is MLI, and it is not a detailed discussion. And we have, this is how the MLI is structured with various parts and various articles. And substantive articles are from 3 to 17. And let's go to the next slide. And each signatory to MLI indicates its position as to what tax treaties it would like to cover. They have given a lot of flexibility. No country is forced to come and sign MLA, and it would not happen also. Every country has its own sovereign right, and it has to protect its sovereign functions. Accordingly, each country is given its flexibility to join the MLI program and sign the multilateral instrument as per its own wish. Today, US is not a signatory to MLI, it has not signed MLI. Even Brazil has not signed so far. Each signatory to MLI indicates its position as to what tax treaties it would like to cover. Suppose I'm not covering a particular tax treaty, it would not be treated as a covered tax agreement. India has notified all its then 93 tax treaties. That way it has all the 93 tax treaties have become covered tax agreements. And signatories can amend their MLA positions until ratification. They have the flexibility to ratify the position, to change the positions. Even after ratification, and the member countries can again bilaterally modify the positions in their bilateral tax treaties. And MLI is not coming like a protocol. MLI is not a protocol. What is a protocol in the international tax? Like an amendment. As how you have an amendment through Finance Act every year to the income tax law. You have amendments that's called protocols to the treaty. It is not a protocol. It is a modification being done through a separate instrument, which instrument works alongside the tax treaties. That is the mechanism suggested by the group of experts. And MLI, they have used the word modifying. It modifies the article in the covered tax agreement. And the modification was deliberately chosen after an in-depth discussion by the experts. Next slide. And as I told, all the inclusive framework countries have got exclusive liberty to modify their positions bilaterally, even after signing the MLA and ratifying the MLA. And how this modification has happened, that is where the entire crux is there. How MLA is sitting alongside the treaty and trying to modify, say, Article 7, Article 5, that is dealing with the permanent establishment. How it is happening? It is happening through compatibility clauses like in place of. In place of means the MLI provision will come and sit in place of the existing provision. Modifies, it doesn't come in place of, but it would modify the existing article. In absence of, if there is no article of that nature, then it will get included now. In place of or in absence of means it would apply to each and every covered taxable. That is how the modifications happen. You need to carefully read the articles of MLI, and you have to see the positions taken by the treaty partners. What position, suppose it's a India-Netherlands tax treaty, what positions they have taken, what positions we have taken to each article, what we have in MLI, and then accordingly decide what is the modification done for the tax treaty. This is a big exercise by itself. You have to be extremely careful. If at all you are trying to apply the double taxation avoidance agreement, this is how you need to do now. You cannot ignore MLA. MLA is part and parcel of the overall interpretative framework. And in this regard, the object and purpose of the convention is to implement the tax treaty related BEPS measures. Then we'll go to the minimum standards I already explained, and go to the next slide. And these are all the countries who have already, and these are all the countries with whom we have the DTAs, who have also ratified the MLA along with us, and as many as 36 countries have now ratified their MLA till now, with whom we have the double taxation avoidance agreement. That means when we are trying to interpret the provisions of, say, New Zealand, you need to see the MLI positions taken by them, MLI positions taken by us, along with the existing provision, then arrive at the correct proposition, what you need to apply to arrive at the treaty law proposition. Next. Next, we are coming to the last module, which will just take another 3 to 4 minutes. And with that, I would be closing my presentation. And transfer pricing is the third topic, which I thought I should discuss. These are all offshoots of BEPS action plan only. See, digital taxation, what I have discussed as the first module of this presentation is nothing but action plan of the BEPS, action plan 1. And then multilateral instrument, all other action plans have been formulated and brought into an instrument called multilateral instrument. Whatever propositions have been brought in the action report, it has come into MLI. Some part of the proposals of the action plans will have impact in the domestic law, and some proposals will come and sit in the treaty law. Such proposals have come into MLI. And next slide. And action 8 to 10 of the BEPS action reports, final reports, deal with transfer pricing principles. And then 13 also deals with the transfer pricing related matters. 8 to 10 have an agenda because the slogan of BEPS action plan in respect of transfer pricing proposition is the value creation is happening at one place, and the value creation economic activity is happening at one place, and the contractual risks are positioned in another place. That means the contractual risks are borne by low tax jurisdictions who are not doing the real work for the economic activity, but entire revenues are getting accumulated in the low tax or nil tax jurisdictions, whereas the value is being created in high tax jurisdictions, which are not reporting this particular income. So there is a disconnect between value creation and the revenue aggregation. So this is being now synchronized. That is, the transfer pricing actions are aligned with the value creation. That is the slogan with which the action plans have been brought in. For that purpose, Now it is transfer pricing officers have been authorized even to recharacterize your transaction and ensure that this value creation is aligned with the transfer pricing actions. Next. And action plan 8 looks at transfer pricing issues related to the intangibles. As we all know, an intangible is developed in India. The outsourced work is given by, let us say, US, because the Indian human resource is cheaper than the human resource that is in US or Europe. Most of the outsourced projects come to India. That is the most popular revenue model, even for the transfer pricing purposes we know about it. So now, in the past, how things are happening, suppose a particular software product has to be developed, like a banking solution or something. The entire work could be outsourced to Indian subsidiary of a large software giant of US, which project will be carried out by India at a cost plus model. It will just, what all cost it incurs, it will just add another 10 or 12% maximum, and then they will bill and collect. And then the entire, the intangible value, everything, the ownership is owned by the parent. So thereby, the appropriate compensation or remuneration or profit is not being apportioned to the Indian entity, which is not possible now because of the new guidelines that have come into OECD TP guidelines 2017. They have come out with various actions, which I will tell you in the next slide. And action 9 talks about the risks must be allocated properly to those entities who have the capacity to bear those risks. And it can't be assigned to some entities and where they don't have the capacity to bear the risk. And action 10 also is including the scope for addressing profit allocation resulting from transactions which are not commercially rational. And there were many transactions happening which are not commercially rational, only to achieve the tax avoidance purpose in the past by the multinationals. Action Plan 13 talks about country by country reporting. That means the international group, the multinational enterprise group spread across various countries, if the entire chart is given in the form of country by country report to the tax jurisdiction, they will, each tax jurisdiction will assess whether proper profit is attributed in their tax jurisdiction, commensurate with the activity carried out. Next. And in fact, these are the DEMPE functions. I have come to the last two slides. And the DEMPE function is of an intangible, is development of intangible, enhancement of intangible, maintenance of intangible, protection of intangible, and exploiting of intangible. So just because you are a legal owner, you can't say my entire profits on exploitation of the intangible must be attributed only to me where I am sitting in a low tax jurisdiction like British Virgin Islands, Cayman Islands, or say Singapore or Mauritius. No, that is not possible. Now, whoever carries out functions in this particular phase, a DEMPE function, that is development, enhancement, maintenance, protection, and exploitation, each player in respective roles must be attributed appropriate profit attribution. And India is also part of this in country by country reporting and master file. These are the two, exchange of information with reference to the entire transfer pricing policy and how they're operating in each jurisdiction. Even India has implemented that. Next. And this is the last slide. And the future of transfer pricing, as mentioned by our Honorable Chairman, Mr. Bansalji, that hard to value intangibles is going to be, because this is a knowledge society now. The information technology companies are growing in a big way. Digital companies are going in a big way. Intangibles, the value of intangibles is going in a big way. So hard to value intangibles for which you don't have comparables. You don't know how revenues are going to be generated by those intangibles. So how do you set benchmarks? Is a very difficult proposition. Marketing intangibles, as I mentioned to you, when your product is publicized in a big way, in a particular market, and it sells in a big way, you have created a marketing intangible in that country. We have the marketing intangible cases pending before the Supreme Court. In the case of Maruti Suzuki, as you all know, originally the issue started in the LG, and then we have the Maruti Suzuki, now it's pending before the Honorable Supreme Court. And arm's length principle is not be all and end all, and every problem cannot have a solution through arm's length principle. That is what OECD and the inclusive framework members have agreed, and that is what is being proposed in the unified approach to bring out the new digital taxation rule that is going beyond the arm's length principle and trying to give a formulary approach. Friends, this is what I thought I would deal with in the limited time available. And in fact, the topic given to me is the new paradigm of international taxation. After a lot of brainstorming with my close friends and my associates, I thought these three dimensions would be most appropriate for discussion with you. My whole effort is to bring broadly at a high level what is happening in the international tax front. And my idea in this presentation is not to familiarize you with the nitty-gritty of each and every thing what I have discussed. And I'm very thankful to the tax friends, various associations, the conglomerate of tax friends, and Mr. Vijay Keval Ramani, and my good friend, Mr. Sachinarayana, who proposed my name as a speaker for this event. And I also thank Mr. Malad Srinivas Rao, who is indirectly instrumental for my presence here in this event. Thank you very much for a very patient hearing. I would be happy to take questions time permitting. And I would revert it back to the Honorable Chairman and the organizers.
Thank you. Thank you, Speaker, sir. And it can be seen the efforts that you have put in making this great presentation. Thank you once again. I think there are no questions asked as of now. We had requested, but still there are no questions. So I would like to invite Chairman, sir, to have a concluding remarks over your presentation.
So I will just take 1 minute before passing it on to Chairman. I'll just take 1 minute. I'm always reminded of a small anecdote just to lighten the burden what we have faced in this marathon session. There is always something called an interpretation which courts will do in respect of terms defined, not defined, and everything. And in a lighter vein, I will share a small anecdote in 1 minute. In a classroom, in an English classroom, there was a discussion going on as to what is the word trousers, Trousers, trousers. Is it singular or plural? Trousers, trousers, that is pants. And no one is able to explain whether it is a singular or plural, because there is a lot of case law that is developed at the apex court level as to what is singular and what is plural. And no one is able to decide. And suddenly an accountant, a chartered accountant has come. He's found and he's invited to solve this problem because there's something to do with the numbers. And the chartered accountant gave a ready answer. Chartered accountants have got ready answers whether they are right or wrong. And the chartered accountant gave a ready answer in the classroom. The word trousers is singular at the top and plural at the other extremity. Thank you very much. And it's my pleasure to be here this morning. And it's over to the chairman. Thank you.
Thank you. Thank you so much. Chairman Bansal, sir, please.
Yes, Mr. Prasad, you have given a wonderful presentation, and I am surprised to hear you that within a period of 60 minutes, you have covered each of the topic relating to the transfer pricing, digital taxation, MLI, then the all problems which is being faced in the present situation. In my opinion, each of the topic require at least 1 hour. In what we can say the representation given by him is a gagar mein sagar. The gagar mein sagar bhar diya ho. So this is the presentation which he has given, and very wonderful presentation. Even nobody has raised any question. I am surprised to see that. This means that the presentation which he has given has clarified everybody about the international taxation.
Thank you.
Sir, there is one question that I'll ask after you complete your concluding remarks. It has just come on.
Question will be from Mr. Prasad?
Yes, yes. Let them ask.
Yes.
Can I
Uh,
ask
Mr.
that question?
Prasad has covered everything
No,
that
no.
now
Let him,
physical presence is not possible under these circumstances also. Now the trading is being done through the digital, and uh, what will be the effect on taxation? How the country should tax the transaction so that the tax may not be avoided?
sir, what is the question? Can you kindly come
Sir,
again?
there is only one question. It is asked by Advocate C. Radhakrishnan, and the question is, what is the position of equalization levy in India?
Okay. Okay. So equalization levy is a reality now. Whether the levy is right or wrong, it has become a reality. And now it is going to cover all non-resident e-commerce operators. That is equalization levy 2. And equalization levy continues from 2016 on the advertisements on online digital space and all that. And equalization levy 2 is very, very concerning because there are many questions unanswered, and there is a strong representation from large multinationals to the Indian government to keep it on hold, pending consensus being finalized by the OECD inclusive framework. Until now, government has not responded to that. And in fact, be that as it may, even if it continues, we would like to know how this levy is going to be administered, because the non-resident e-commerce operator has to comply with these rules. And how do you enforce? He is not a resident. He is not available to you. And how do you enforce that he does and comply this? This is a big billion-dollar question. And not only that, and there are instances of double taxation, as I mentioned. Equalization levy overlaps with 194 WO, what is proposed. And equalization levy, there is no credit of such taxes paid in the resident country because it is not recognized as part of the treaty law. And there are many issues, and we do not know what is an online platform. Whether suppose I am a non-resident, I come to India with an IP address, I am of Indian origin, with IP address here in India, if I make a booking, for my utility outside India again, even that would come under the scanner of equalization levy. So there are many unintended consequences that are arising because of this levy. This levy is really rushed in great hurry, which no one knows, no one expects, because it was not introduced in the bill. And it suddenly came up as a surprising shock in the Finance Act. So at least now, I think because of the pandemic, there is already a representation to keep this equalization levy on hold for one more year, so that meanwhile a consensus can prevail and we can arrive at a more practical and a more desirable approach of the levy. So that is what all I could say for the present.
Thank you, sir, for your response. I think there is one more question. Can I take this last question?
Yes.
Yeah.
And organizers have to tell, I'm ready. Whatever way. You can tell it. You can read out the question.
Actually, I'm not getting it properly, but I think what the question says, can you take few everyday life examples, sir?
Pardon?
Can you take any few routine examples, everyday life examples?
Regarding
equalization levy.
Equalization levy.
Just one example if you can give.
Equalization levy. The other day I was just going through one case study where suppose you have Netflix, you are a user using Netflix. Suppose if it is used by any chance by your office for the for any streaming of any particular particular content or anything, then you will come under the equalization levy impact. And such a even the Zoom platform what you are using, and everything would come under that, because it comes under the service, because you are utilizing the service to carry out the event. This will come under equalization levy. And even your Microsoft Teams, if at all you are paying for that. Google Meet also, there is a payment beyond a particular level. So all this will come under the equalization levy. And these are some of the glaring examples what we have. Even the hotel bookings, now there is no clarity. If at all you make a hotel booking on an online platform where you get real discounts for your hotel, but in real the service is physically made. So you are going to use the room, go stay there. But in spite of it, because you made an online booking, there's no clarity that might come under equalization. Same way the flight bookings. These are some of the classic examples for which there is no clarity today. So that is the reason the scope is very, very, unwieldy, and the scope is very, very bothering. And we need to know where we stand, for which we request the CBDT to come out with more clarity.
Thank you, sir. Thank you so much. Chairman, sir, if you are done, so can I?
Mr. Prasad,
Yes.
will it be on the source basis or on the residence basis?
No, actually, equalization levy, there is no source, or they are telling it is beyond the treaty law. It is beyond the income tax law. Under what law it is being brought, we don't have the clarity.
Will it be unconstitutional then?
That is the most important question you are posing, sir. And constitutional experts feel that it can be challenged under the constitution, because they say that GST, after the advent of GST, equalization levy has no place. That is what they say. Constitutionally, it can be challenged because there is already a transaction tax happening in the form of GST. So definitely that can be challenged. That is what is the strong popular view of the scholars.
Does it not fall within the action plan?
No, an action plan one suggests
Entirely different one.
No, pardon?
It does not fall within the action plan.
No, action plan one, that is the, see, our government says that they have followed the suggestions given in the action plan 1 report of 2015, which they have mentioned withholding taxes, equalization levy, and significant economic presence as the 3 pointers for digital tax. That time nothing was finalized. It was totally at a raw stage that time. And that was taken immediately, and we have jumped at it, and we have brought in equalization levy in 2016 itself. But they have very categorically mentioned, the report has categorically mentioned, whatever levy you bring in, it must comply with the treaty obligation. But now it is going beyond the treaty obligations, because whatever you pay, non-resident pays, that is not going to be given as a credit in the resident country. So it is not fitting into the treaty obligations at all. See, that is what is being opposed strongly by the international community.
But the treaty amendment will take a lot of years. It's not going to be amended.
Sir, let us proceed. There's one more question and we have to end also. People are waiting for that.
This is the last question, and then we'll go for vote of thanks. The question is, transfer pricing rules on manufacturing are... Sorry, the question
Pardon?
Just a minute. The question is, transfer pricing rules on manufacturing are creating problems. Hence, we are going to Colombia, Thailand, and other countries. The question says that there are some problems in the transfer pricing rules are creating some problems for manufacturing. Hence, these manufacturers have to go to the countries like Colombia, Cambodia, Thailand, and other countries.
No, it is not the transfer pricing rules, because there are no separate rules for manufacturing activity or anything. Transfer pricing rules apply across the board for all transactions. And in fact, I would be optimistic with the Make in India concept now being very strong after the recent developments. Definitely, the Indian government would not spare any effort in creating the conducive atmosphere to attract foreign investments into manufacturing sector. And whatever transfer pricing issues that are there, by and large, I think there would be more of safe harbors practically created, which are acceptable to the industry, and all that framework would happen very shortly. That is what is my optimistic view.
Okay, thank you, sir. Now I invite our conference coordinator, Shri O.P. Shukla ji, to present a heartiest vote of thanks.
Thank you, sir. श्रावण मास में बाबा विश्वनाथ की नगरी काशी से जो ज्ञान, भक्ति, वैराग्य, मोक्ष व कल्चरल हेरिटेज के नाम से शास्त्रों में जानी जाती है, मेरा वर्चुअल नेशनल टैक्स कॉन्फ्रेंस में भारतवर्ष के विभिन्न प्रांतों से सम्मिलित सभी सम्मानित सदस्यों को सादर प्रणाम व साथ हुआ। After an exhilarating and wonderful executive session, it is proud privilege to propose a vote of thanks. First of all, our sincere thanks to CA Vijay Bhai Keval Ramani, immediate past president of Tax Friends Pune, and conference chairman, who have organized wonderful first virtual national tax conference in association with our Income Tax Bar Association Varanasi, GST Bar Association Varanasi, Tax Practitioners Thane, Income Tax Bar Association Prayagraj, Bhiwandi Tax Practitioners Association, and Jodh Professional Foundation. And also thanks to Vijay Bhai, who have organized 50 virtual seminars in lockdown period. He deserves to be big clap, and और इनकी प्रोफेशनल क्षमता की जितनी तारीफ की जाए उतना ही कम है. Friends, our sincere thanks and congratulations to all the members of our Income Tax Bar Association, GST Bar Association Varanasi, who have given extreme support to the first virtual national tax conference. And also thanks to all the associate concerned member who is participating in this first virtual NTC. Today, first technical session has completed, and first of all, I thanks our respected of the session chairman PK Bansal sir, former vice president ITAT, who is encyclopedia of income tax law, and who have very well conducted the session. I have been lucky to present in number of appeals before him, and it has always been very satisfying appearing before him, notwithstanding the outcome of the appeals. Today, the subject is international taxation, new paradigm. The Revenue Authority must protect their revenue base without hindering the development and use of the new technology. Low-income countries are more dependent on corporate income tax revenue than richer countries, and at the same time, these are proportionate affected by tax multinational avoidance. Our research of this theme investigating ways in which developing countries protect their tax base, including through simplified transfer pricing method and improved tax treaty policy. It also examines the challenge and opportunities developing countries face from their participation in international tax negotiations. Our sincere thanks to keynote speaker CA PVSS Prasad ji, who have explained the extremely interactive subject in such a lucid manner, and tax avoidance policy. India and other countries has executed double taxation avoidance treaty, but looking to the world economic scenario, the treaty made with United States, Russia, China, Australia, Japan, and other neighbor countries must be reviewed. And computation of income from international transaction have regards to arm's length price, meaning of associate enterprises, and meaning of basic domestic transactions, reference to transfer pricing officer, and avoidance the pricing agreement must be reviewed. I also thanks my friends on the dais, Biren Papat, who have introduced the biodata of chairman and the keynote speaker. Lastly, but not the least, thanks to each and every delegates who have participated and benefited from this session. As